Welcome back. Now it's time for a very big conversation. Banks have been having a tough 2024 with a virtual war for deposits, even as pockets of NPA stress have started opening up in microfinance, in unsecured loans, as the Reserve Bank was alerting. Now, of course, Axis Bank results reflected some of these issues. The bank's slippages did rise, and their provisioning, or what you call credit costs, have also risen. Reserve Bank is now likely to make it even tougher for banks by asking them to hold more money in liquid assets like government bonds. That is, the LCR ratio is going up. So how's the year ahead looking like? I have with me one of the biggest bankers in the country, Amitabh Chaudhry, Managing Director and CEO, Axis Banker. Good morning, Amitabh, and thank you very much for your time. But let me start with something hopefully pleasant. You saw the events overnight in the US. We saw very bad manufacturing numbers, ISM manufacturing numbers, very high jobless claims. And therefore, now the bond yields over there have crashed below 4%. Do you think we are inching closer to a rate cut in India?
Well, we have been hearing about rate cuts in the US and the global economy for quite some time, and it's been a bit of a journey, rates being cut, rates going higher, rates remaining the same. Our view, and I think a view which we've held quite steadfast over the last 12 months or so, is that I think the rates in India will remain high for longer. I'm not saying they'll go higher, but they will remain high for longer because the drivers for India, apart from what's happening globally, also is that, we need to continue to tame down inflation. We're still not at the 4% target. While, as you rightly said, some of the numbers in the US are not looking very good. At the same time, we cannot forget the fact that the global political situation remains quite volatile with what is happening around the world. So, and I think India will and can get impacted very quickly, given, the import of oil and so on and so forth, and Middle East remains a hot spot. So my view is that while these numbers do indicate that the Fed might have to act or do something faster than what we expected earlier, but will India immediately react and do something here? I think RBI will take stock of the whole situation and move quite deliberately, but not in a hurry whatsoever. So my view is rates will continue to remain high for longer.
Yes, actually, we had Neelkant on the channel yesterday, and there is this big worry that a Trump win might mean higher tariffs, and that can push inflation higher in the US. Okay, that's another topic altogether. But just coming back to this scramble for deposits, do you think it's time maybe the Reserve Bank thinks of a CRR cut?
Well, you have to look at, the recent draft circular on LCR, and on the top of that, if I say, oh, by the way, on the side, please cut the CRR. I think they have to look at the whole situation, and I'm sure they are, quite holistically. On one side, they are quite worried, and they've been talking about it for some time, that given some of the events and how they played out in US, with SVB and some of the other banks, they have on one side talked about, you mentioned in your opening comments also, talked about a higher LCR and what it could mean in terms of the amount of assets the bank has to hold as HQLA. That's one side of the story. On the other side of the story, the deposits remain tight. What are some of the actions which Reserve Bank of India could take to ease the deposit situation? My view again, I'm no one to kind of predict what RBI will do, but the LCR move is going to take an excess demand for HQLA of 4 to 5 lakh crores. And frankly, if you just do the maths, the number could be obviously much higher, close to 7 lakh crores. But, one is assuming that people or the banks will dip into their excess HQLA and only buy as much as what might be necessary.
Exactly.
Now, so on one side, we have to put in more money into HQLA, and it will have, if nothing else is done, if banks absorb everything, it will mean obviously an impact on margins for all the banks, anywhere between 5 to 15 basis points. And this is also assuming RBI will do exactly what they have said in the draft circular. On the flip side, banks, could decide to pass on some of this impact to the customers, either in form of higher charges or in the form of higher rates, or, hopefully RBI will not do exactly as what they have said. So let's see how this plays out. CRR cut is only one of the things which is kind of things which are available to RBI to kind of manage this on the other side. But let's wait, because, I think they're quite open to listening to feedback. They're listening to feedback. Let's see.
Okay, no, I just want to tell those the viewers who aren't so keen into bank balance sheets. At the moment, banks have something like 25-26% of their deposits in government bonds, what Amitabh referred to as HQLA, high quality liquid assets for their liquidity coverage. And then they have another 4% money in CRR. So already nearly 31% has been impounded for the statutory rules, and another 2% more on PCR, on provision cover, will mean that 1/3 of the bank balance sheet goes away and is not available for lending, and maybe the Reserve Bank will think through that. But Amitabh, what are your own
I'll
numbers?
just add that if it is implemented as is, this will be equal to what existed in 2008 when SLR and CRR requirement was 33% of NDTL. So just to do a comparison.
That's some perspective. I remember 9% CRR under Dr. Reddy. That was the last decision he took. But Amitabh, what is your own liquidity cover ratio now, and what do you see it under current RBI draft rules?
Well, we have not given any guidance on that because we are waiting for RBI to first finalize these rules, but we have been maintaining our LCR around 120% forever, including during the COVID period. We have enough cushion available from what RBI expects us to maintain it at. So you would expect us to be in the 115 to 120% range. Obviously, it's a dynamic number, but that's what we would like to maintain. Please understand that LCR is not the only number which you have to take care of. LDR is another.
Yes.
RBI has been driving quite actively over the last couple of quarters. And as we have stated in our calls, we have a clear strategy outlined. RBI has seen that strategy, is broadly okay with it, and we are continuing to implement our deposit and our advances kind of growth under that strategy, which has been obviously signed off by the board and RBI.
In your latest numbers, your advances growth is faster than your deposit growth, I think by 1 percentage point. What kind of growth forecasts are you looking at? Will you look at lowering your loan growth? And if you can also guide us on, therefore, what margins will you be able to keep to the 4%?
So you raised a couple of questions. One, as you rightly pointed out, we have been saying, I think for the longest period of time, that the deposits and the advances growth does need to converge. They can't be running. The credit growth can't be running way ahead of deposit growth. And again, we have been saying that number will be most likely close to 13% for this financial year. So we have maintained that stance, I think, quite consistently. We have also said, as Axis Bank, that we believe in the medium term, we can grow our advances at the rate of 300 to 500 basis points higher than the industry. Now, that is medium term. It's not for this year. Obviously, it is not possible unless our deposit growth also is in line with that advances growth. Yes. I mean, because of all the things which I've said, it is obvious that we are in a way saying that the deposit growth would be similar. So, so that's on the deposit and the advances side. As far as the margins are concerned, again, we've maintained a consistent stand that on a kind of through the cycle, we would like to maintain NIMs at 3.8% and above. We have been able to maintain it 25 basis points over 3.8% consistently over quite a few quarters. And obviously, we'd like to keep this cushion as much as possible. So what we are saying is hold us against 3.8%, but we are striving very hard as an organization to ensure that we maintain this cushion of 25 basis points, which we have been delivering quite consistently for some period of time. Now, obviously, some of these new things which are coming up could have an impact, but let's see ultimately what the final shape of the guidelines are.
Okay. Well, as a bank within the top 5 in India, what's your sense about deposits itself? Do you think they're going to get even costlier before they start declining? Before the cost of deposits start falling?
Well, we are living in a very clearly a deposit constrained environment. And it is quite clear that there will continue to be intense competition for deposits. You will see some institutions managing that intensity in the short term because they have some specific context. Some of them obviously will play the long-term game. As far as Axis Bank is concerned, we have been driving a granular transformation project on the deposit side for quite some time. As we have again mentioned in our calls, we are seeing some green shoots. But it's a ship which you're trying to turn around in a certain way. It does take time. We believe that while we are doing that, we also have to do the right thing. So you are aware that in terms of outflows on the LCR side, we have brought down our outflow rates by 400 basis points over the last 2 years, which places us among some of the best banks in terms of the overall outflow rate. So we have been slowly, gradually making a lot of changes in our deposit franchise, which might not be visible to the naked eye. But our view is intensity will remain. Our view is in the short term, some players might do things which, obviously will give them some deposits in the short term and I'm not questioning what they're doing. They might have their own context. We are trying to drive a very, very long-term strategy here. We believe that's the only way to set our ship right. We have been on this journey for some time. We are quite happy with the progress we have made, but we still got a long way to go. And that's exactly what we are striving for across various parts of this.
No, 4%. That I just wanted your NIM's view.
Oh, well, I said that, we'd like to maintain that cushion to 25 basis points, about 3.8%. So we're trying and striving hard. I'm not trying to give a guidance, but obviously the organization is quite focused on NIMs. And, especially when your deposits are constrained and you are having a risk-adjusted return on capital kind of model, so then you do need to drive a certain waterfall. Obviously, keeping some of the risks which are emerging also in mind. So I'm not saying it's impossible. It is tough, but it is possible at the same time to be able to maintain this cushion or be in the zone of that cushion for some time.
Yeah. No, I mean, at the moment, volume of loan and margins are both highly in a highly competitive zone, and hence the pressure.
That makes the job quite exciting. So that's okay.
Exciting, challenging, tough. Yes. Okay, Amitabh, credit cost. That was the big worry for analysts, and everyone has chosen to comment on it. You had said that you would be able to improve recoveries, and that will bring down the overall situation. Can you just put some numbers to this? What may you end up in terms of credit cost? What may you end up in terms as recoveries in the current year, FY25?
So if you just give me a couple of minutes, I would first like to provide some pointers of the trends visible at the industry level. We are seeing increase in credit costs across the retail unsecured portfolios at the industry level, which is to be expected, something which we've been talking about, given that you can't remain at trough levels on a through cycle basis. We have also seen a slight increase in delinquency at industry level based on bureau data, especially for personal loan and cards. So the reason, and if you look at the recent Q1 results commentary from banks and NBFCs, they have also highlighted that the normalization trend in slippages, credit costs, with slowdown in recoveries and upgrades, and some pickup in stress and unsecured loans is visible, and they are also all tackling it. Now, as far as coming to Axis Bank, we believe that the credit costs for the system and for us cannot be at the levels they have been in fiscal 24. They need to move up, primarily driven first by slowdown of recoveries and upgrades, which we are starting to see. So we have been saying this forever, that the credit costs will normalize. They may not normalize to what we have seen in Axis Bank in the past. It will be quite lower than that, but they will normalize first. We are also seeing increase in credit costs across, as I said, retail unsecured portfolios, which is expected given it can't remain at the trough level. So we have been taking proactive risk action for close to 6 to 9 months now and working within the defined risk guardrails which we have for the bank. We continue to monitor our retail unsecured portfolio. We believe that the calibrated actions that are being taken will play out over the next 3 quarters, along with other actions that we are taking, and we will show improvements. So while we do not provide guidance on credit costs, let me definitely say this. While our first quarter net credit costs in 90.97 basis point, 95 basis point, not reflective, and let me repeat, not reflective of full year credit cost expectation, as first quarter credit costs is impacted negatively by certain timing differences. And obviously, apart from the timing differences, we expect some of our actions to bear fruit, not immediately, but over a period of time. So, yes, while the first quarter had, firstly, the seasonal effect, the first quarter had some timing differences, and the first quarter had the impact of, anyway, the fact that the recoveries are, reducing, and that you are seeing some deterioration in the unsecured portfolios. But we are hoping that over a period of time, we can, get the ship moving back in the right direction.
Okay, just one final question, because there is a gun to my head on commercials. Do you see more OPEX control? I mean, you surprised us with a lower OPEX. Do you think that there are more synergies now with the Citibank, that card portfolio in the max sales on? Do you think you will be able to reduce OPEX and increase fee income?
So I think as far as fees is concerned, if you look at our fees to retail assets, we are one of the best performing banks. So there is little leeway left in continuing to juice that franchise. I mean, as we grow, fees will grow, but nothing beyond that. As far as OPEX is concerned, yes, we've been investing a lot in some of the specific areas we've identified: IT, analytics, digital. We're also running various transformation projects. We obviously want to see the benefits of this to play through. As the overall advances slow down, or they are lower than before, We do believe that over a period of time, we should be able to continue to manage our OPEX as we move forward.
Okay.
And I think we have demonstrated that in the first quarter. Please also realize that we will get some benefit of the fact that now the Citi acquisition is over. We were incurring one-time costs every quarter to support the
Yes.
the Citi systems, and there's some payments going out. That will all stop now, but amounts are not large, but they will definitely help us in reducing our costs, at least from the base level perspective.
Okay. Out of time, Amitabh, but not out of questions. I'll take a rain check from you for a longer chat sometime. Thank you very
Thank you
much.
so much,
indeed
Latha. Always
for
a
joining
pleasure.
us.
Thank you.
Okay, we are wrapping up on Bazaar on that note, and also on the note that the markets have shown some bit of recovery from the very steep losses we saw about around 10 a.m. Let's see whether we have seen the bottom for the day. We wrap up on Bazaar. Chartbusters coming up.